Finding the right businesses, it's not about public listings, like we said. They're for people that don't know what type of business they want to buy. You already know what type of business you're looking to buy, right? You're looking for a property management company.
You might know how to run a property management business, but if you've never bought a business, this is a big investment. You might be taking out a loan, personally guaranteeing a few $1,000,000. And if you fail, you lose your house. If you aren't the expert at it, don't try to do it by yourself.
Hey, welcome everyone to the Managed Exit Podcast. You got myself, Aaron McElhenny, and we've got Hunter Goodall here today. And we are going to go over the top questions that you all have about property management business acquisitions. So let's get after it.
All right, let's go.
Okay, what is a PM business worth? It really is going to boil down to cash flow, right? EBITDA or cash flow or SDE, whatever that is, depending on the business. We need to figure out what that business is making per year for the owner of that business. And it is going to be some multiple of that cash flow number, that EBITDA number, that seller's discretionary earnings number, SDE. Every business is a little bit different. So we like to dive in, understand what it's making per year, and then also compare it to closed transactions that we have done. We've done over 450 transactions. So we have a really good indication of what the value of your business is, what multiple you should be earning for the sale of your business.
Yeah, I think that's mostly it. People don't confuse the idea of a multiple on revenue, right? The banks aren't going to consider that. It's multiple of cash flow, because the cash flow is the ability to pay the note, right? So yeah, whatever that cash flow number is, that's the starting point for how you figure out what that business is worth. This is a great question. And I think people ask this one all the time. Someone just called me yesterday asking like, hey, what a property manager, what's the multiple for a property management business? And it's funny. Everybody in property management always wants to jump to the door count. Is it a price per door? Is it a multiple on the doors? And it's like, no, that's just one of the variables that go into the multiple. But the standard multiple, it could range. 3x is usually a good benchmark, but that's not the go-to number. It's like we said just a second ago, you got to figure out what that cash flow number is, but there's a lot of variables that go into it. Beyond that, the cash flow number just kind of like paints the picture for what that operation looks like. But then you got to look at all these variables, and including your own the buyer's risk portfolio. Like, what are they willing to put into that? And that's why it could be anywhere. Usually, we're seeing anywhere from 2 to 3.5 times cash flow on these property management businesses. That's a big range, but it's because there's a lot of variables that go into it beyond just the financials of the business.
Sure. So that's why, going into evaluation, that person conducting the valuation, like something our team would do, they really need to have good understanding of the quality of the portfolio, that of the business, that of the employees that are there, the owners, role in the business, how much time they're spending in it. All of those are going to impact the multiple. So yeah, every deal, like I mentioned before, is a little bit different, and that's why it's critical when going through evaluation, not just to go and do a quick Google on, hey, what is a business worth, and use some number that could have been pulled from another industry, another business size or business class. More recently, someone was mentioning a 5x multiple that they had seen on another business that was in another industry that was in a completely different ballpark as far as revenue goes too. So you need to compare your business to other businesses that are of your size, and obviously diving into it with the team that has a database, not just of closed transactions, but even market specific data, right? The multiple may vary by market, right? Top tier markets with great rents versus low, sub tier type markets. There's a lot of variable in there. Like I mentioned, the quality of the portfolio, the location of the business, the org chart, the team that's in place. All of these things will absolutely impact value and those multiples being used.
We have a model that we've built, a valuation tool, and it's PMIacquisitions.com. is where you can go in and fill in some data from your own P&Ls, your own revenues and cash flows on your business for the last 3 years. That is really meant to give a good starting point, right? Aaron just went through a lot of different variables, a lot of things that we look at, but the financials, we always start with the financials to get that starting point. Like I said earlier, that the financials of the business just paint the picture of how strong of an operation there is, right? That gives us our starting point. Then we can jump into all these other variables, the transferability, the infrastructure, risks, can they be mitigated, the market, competition, all these factors that go into that multiple. But we start with the financials to tell the story of how strong of an operation this is. And then let's go from there to figure out what kind of multiple do we feel comfortable with. So that's why there's a range on these multiples, and some buyers might be comfortable with a higher multiple. Some might be, hey, they can only have a lower multiple. But yeah, use that website, pmiacquisitions.com. You can check out that free valuation tool to get that starting point of, hey, based on the financials, it should be in this range. Let's dive in deeper, right?
There's a few different things that I think you should really look at to increase the value. We had a call with someone in one of the Carolinas today who's looking at exiting in the next 2 years or so. They went through evaluation, didn't get a number that they wanted, and now have a bigger target to say, "Hey, I want to aim for, this new target, this bigger exit." And ultimately, it resulted in him, figuring out that, hey, he's going to have to, grow this business. He's going to have to continue to remove himself personally from the operation. That's a big piece that we work with a lot of sellers on, where they're an owner operator and much of the business relies on their involvement, and they're working full time plus. And so I would suggest that remove yourself, from the operations as much as you can. Get the right team, the right systems, the right vendors, the right partners in space in the business to help kind of minimize your involvement. So that ultimately that's going to help transition you out of the business sooner, right? Still increasing the value of your business and now multiple, because you are taking maybe a semi absentee type element to the business. But there's a lot of things we could talk about as far as increasing the value. Maybe you have a couple ideas, Hunter.
I have some thoughts. Yeah. So, step one, I would say clean up the financials. Messy, unorganized financials are a clear indication of how the rest of the operation is run. And if the business is littered with personal expenses and we got to go and do a bunch of add backs as we're making adjustments on this, that's not as clean as we would like to see. We get excited when it's like there are minimal add backs, adjustments that need to be made to this business, right? The quote, get the boat off the books. All of your personal expenses, get them off, right? Because then you have cleaner financials, and that paints a good picture for the rest of the operation. It really makes the business stand out of like, oh, look, this is a clean, organized operation. But to Aaron's point, get yourself out. Like, go take a 2-week vacation. And if you can't do that, why? Like, put some standard operating procedures in place, document everything, and then go take 2 weeks off. If you can't do that, your business is not going to have as high of a multiple. We just did a deal where the owners frequently, like 6 times a year, take 2 or 3 week vacations with no internet. That's a business that we can get excited about because the business is not dependent on the owner. It still runs at full capacity when the owner was gone, right? So that's a good stress test of, can you leave? Can you take 2 weeks off? And will this business still keep going without you? That's how you can increase the value. If you can't, then do an assessment to figure out why you can't take 2 weeks off, right? And I think the first step to that is documenting all the standard operating procedures of every role and seeing where the gaps are and how you can fire yourself as much as possible. It's counterintuitive because it's going to cost you more in payroll to fire yourself and hire somebody to take over different responsibilities. But overall, that makes your business more valuable. That gives your business a higher multiple when you want to exit.
I love that idea of the stress test. It's definitely going to help identify some of those pieces. Ultimately, it's giving up, some responsibilities to other people, or like I mentioned, team members or other. But ultimately, that's going to happen when you sell this business. And if you can kind of put that pressure on it now and kind of build more of a reliance on the team than yourself, it's only going to help you more too. So not only will it increase the value, but it's going to help with the transition of the business post close as well. So buyers will see that and see the value in that too. So
I'll give an example of two similar deals that we're looking at right now. One that their cash flows are pretty close to the same, but one of them was because the owner does everything. They have really high margins because the owner is doing everything. He's in the weeds. Versus another one where the business hires, they have a lot of people there, but their cash flow is about the same. But one of these has a much higher multiple and they're selling for about double what the other one is selling for. And it's because, you know, they invested in putting people in place to do a lot of the tasks. It's not as dependent on the owner, less risk, right? Versus the one that is dependent on that owner and that owner is doing everything, it's higher risk. What happens when that owner is gone? Are they the special sauce? There's so much uncertainty because that owner can't even take a vacation, can't even step away for a week, you know? So it's like, yeah, this business is the cash flow is about the same. They're not taking home as much as they could if they were doing more, but they're exiting for way higher because they've built up the infrastructure around them.
if you've got clean financials and have done some prep to have the disclosures ready, I think a 3 to 6 month window is fair. That's going to allow for any kind of bank financing that might be required. Ideally, you're not immediately rushed to have to sell tomorrow. It's like, hey, you've got some time to prep, and I think we'll have. So another question upcoming about finding the right buyer. This will definitely lead into that. But let's say you found the right buyer and they're qualified to buy. A 3 to 6 month window is pretty fair.
Yeah, I'd say just what we talked about earlier is uh, clean up your financials, get them organized, get the boat off the books, get all of your personal expenses out of there. Stop planning. Like if you're looking to sell, you want 2, maybe 3 years of runway of get the boat off the books, set like pay the taxes, like you're not trying to reduce your taxable income when you're trying to sell your business. Let me rephrase that. You're not trying to minimize taxes. Just suck it up and pay the taxes when you're trying to get your business ready to sell. Like you want at least a 2-year runway of having clean financials showing a net income because that will make your business a lot cleaner. You'll have a couple years of history of showing clean financials and profitability. So that would be step one. Step two would be take a 2-week vacation. And if you can't, document your SOPs and figure out who needs to be doing what so that you can take a 2-week vacation.
Oh yeah, I mean this is a big point to hit on here. I mean we do have non-disclosure agreements in place between buyers and sellers at all points. Even if our team's going through valuation, we still have an NDA in place. But confidentiality is everything. The last thing we really want to happen through the process is for team or for clients to figure out what might be happening here in the background, especially when it's just going through a discovery type period, right? It may not even be, this is all the work before an LOI or initial letter of intent is even signed. This is just initial diligence where confidentiality must be upheld. It's critical. It also goes both ways, right? A lot of sellers think, hey, well, this buyer is going to be learning a lot about my business. Well, hey, you're going to be learning a lot about the buyer's business too, and that NDA is there for a reason, and it's critical. It's strict for a reason, and it really is kind of the the backbone of trust between buyer and seller. Both of them have the intent to do a deal together and find the win-win. But yeah, confidentiality is everything. Protect your clients, protect your team, do everything you can do to make sure that I mean, you must maintain that confidentiality. So absolutely critical.
But like you said, it's also on both sides of the table. Like sellers are always worried that the buyer is going to slip up and say something. The buyer is just as motivated to keep that confidentiality. They do not want the employees finding out too soon that they're talking about possibly doing this acquisition. 'Cause then all of a sudden you got the buyer has to worry about, well, is the team, they're all freaking out thinking that this business might be sold. They're going to go job hunt. Like nobody wants this. So it's mutually beneficial on both sides of the table that buyer and seller maintain that strict confidentiality and keep it that way as long as possible.
Oh my gosh, that is loaded right there. I mean, I would say the typical process there is, there may be some key individuals on a team that could be part of it, but ideally, not until a purchase agreement is signed. That's not to say that money is transferred and changed hands yet, but we need to have a solid agreement in place before any kind of disclosures are made to team members on either side, and clients. It's usually not until closing that kind of openness is there for team members and clients. But yeah, I mean, Hunter, you and I have dealt with this quite a lot, and I'm sure you have some opinions on this too.
I think, yeah, you don't want the employees, neither party want the employees finding out too soon. When they find out too soon, they start to panic, they start to search for other jobs, and next thing you know, they all quit right when closing happens. And there goes a lot of the value of the business, right? So usually we say, hey, like the last week before closing, maybe 2 weeks before closing, that's when the buyer should be introduced, the seller should introduce the buyer to the team, but definitely not before that, except when there are critical key people that the seller is confident are crucial and will likely stay for the new buyer. We have done that in a few scenarios where, the buyer comes in and it's like, hey, out of these 15 employees, you should probably be talking with these two because they're going to be critical. So let's start those conversations early, and that way they don't feel blindsided. They feel like excited that they're part of the process. Like, don't let any of the other staff know, but you two are in on this. But it's because we gotta strategize. We got to interview them and talk through, how this is going to be and how we should handle this operation moving forward. So I say hold off on introducing team and clients as long as possible. But with that, I mean, there are some deals where a lot of the contracts they're not assignable without prior written consent. So it's like you have to put a rush order in like that last week before closing of getting new contracts signed by the client saying, hey, by the way, we've got this new buyer. They're taking over these contracts next week, and we need you to sign this consent. There's language around it of getting that consent, but yeah, you want to hold off as long as possible before letting others in on the transaction.
Yeah, just another quick comment on that. I mean, it's really something that needs to be agreed to by both parties. I've seen it where a seller, at their discretion, decided to inform team members, and it negatively impacted the deal. They notified them too early. It wasn't the buyers. It wasn't to their advantage. It wasn't their idea at all to do that. So I would just say any decision around client and employee communications, whether that's before close or post close, all of that communication needs to be agreed to by both sides, right? The seller will know which clients are going to need extra attention, which employees may need extra attention. But yeah, I would say typical process is not, no communication of the sale until post close. We talk about business brokers all the time, and I'm not going to be negative when I talk about business brokers because I think there are a lot of good business brokers out there. I would just say it really depends on the seller's position, right? Are they heavy into their network? Do they already know other potential buyers? Can they already provide clean financials? Well, in my experience, a lot of business brokers, that I've worked with have guided sellers through valuation, through, preparing their business to sell, and they're going to take 10, 12%, sometimes more. And so, I mean, I think to a seller's advantage, there are so many resources that are available to them now, including free resources, not just our team, but there's others too, that they can get valuation from. And I don't think you need a business broker to sell your business in today's day and age. Just in our space, I see 98% of them transact without a broker, and I see all of them getting fair value on their business. And that might just be my opinion. I think they can be used. And I think there's a space for them. Someone that doesn't want to, facilitate a seller that doesn't want to talk to 10 or 20 different buyers and just wants a broker to do that. And if they're willing to pay the 10 to 12%, go for it. But I don't think it's necessary in our space.
I'm a little torn on this, depending on which route, which seat I'm sitting in. If I'm selling a business, my thoughts are stay in your lane unless you're an expert at it. Stay in your lane, because don't try to Google what your business is worth and then try to sell it off of that, right? So either you could either talk to brokers or get a valuation. I think the brokers could really do a lot to help sell that business. They could probably do a better job of selling your business than you could in most cases, because this is what they do. Flip side, on the buy side, I prefer not buying businesses through brokers, because we know what to target, so we can just go straight to it and bypass that. Kind of the benefit of working with PMI, if you sell a business to PMI, we waive that fee. We're not going to charge a 10, 12% transaction fee, but you're still going to get the same deal that you would have if you had a broker involved. So that's kind of the benefit of selling to one of our PMI franchises, is you can save on that 10 or 12%. But if you're not selling to one of our PMI franchises, I don't know, do you know how to sell a business? Like, if you do, great, go for it. If you can get experts to help you, I think, I don't know, I'm torn. Aaron's looking at me like, how dare you say,
Yeah.
say that? But I'm thinking, if you're not the expert at selling a business, hire an expert to help you sell your business.
No, you actually made me think more about it too, because I was thinking about someone that, maybe they've gone through an acquisition themselves, like this person I spoke to earlier today, who has actually done 2 acquisitions themselves. And so I guess the experience of the seller is the big factor here, right? Are they familiar with the transaction process? Do they understand business valuation? And I see why the resource is there. And like I said, if that's something that someone wants to hand off to a professional, I totally understand it. But I do think that there's a lot of property management specific business owners that are very involved, not just in industry networks, but they have access to a lot of different valuation tools and resources there. So I think you could do it yourself if you're confident in your abilities to do that, and you're up on, if you're paying attention to the resources that are out there providing this, great. But I'll tell you too, like it could definitely simplify the process. You can still earn a great dollar by selling it yourself. There's plenty of guidance around this. I'd also kind of say there's probably a like level of sophistication of the business too. I'd say a lot of the deals that we look at that are kind of sub $3 million, I can imagine someone looking at that 5 to 10 mil or plus space. There's some added sophistication to that not just a business broker, but your attorney and your CPA are all going to be working together in that way. So probably depends on the sophistication of the business that the seller is working with. And yeah, I wouldn't force feed a business broker in there, but I think if you're capable and you're confident enough, then you can find a way to sell your business and forget all about that 10 to 12% broker fee.
Yeah. So there's a few different buyer profiles, if you think about it. Everybody dreams of selling to institutional buyers, private equity companies. You got to have a really strong business for private equity to be interested, right? I read a book called Maximize Your Multiple. And in that, they were like, yeah, the reality is institutional money doesn't care until there's 10 million in revenue, right? So, and in that case, get a broker. So the private equity buyers, they pay big money, but it's hard to get their attention, right? And you have to have a really strong operation for them. The next is on the low end, you've got the entrepreneurs. Right now there's a lot of kids coming out of college who want to buy businesses. There's a lot of push on social media for, executives at their companies, leave your job, go buy a business, but they have no experience buying a business. They don't have an operation that they can fold this into and get some synergies from. So they're going to be limited on what they can offer. So they're going to be on the lower end of that valuation. And then the middle ground is sell to one of your competitors, right? Sell if you've got a property management business and you're like, I don't know who to sell to. Talk to the other property management companies in your market, because they can give you they can give you a better price than the entrepreneur through acquisition people. And they're going to do a really good job of taking care of that operation as opposed to, kind of a property or private equity model is typically buy a business and slash as much cost as possible. A lot of times that includes headcount, right? But your competitor down the street, they typically want to buy the business for the contracts and the people. Like they want that business and they can blend that in and be like, hey, I don't need 2 leases. I don't need 2 marketing budgets, but I do need your payroll. I need all your people there. So it's ideally that's your best strategic buyer is somebody who's already operating in that space and could just absorb your business. They're going to be able to give you the best price and it's going to be the best, smoothest transition.
Yeah, I'd say a lot of the times, sellers are aware of who the really good operators are in their market. These may be personal contacts that they already have. They might be groups that are down the street that they've never talked to. Case in point, the deal we just closed 2 weeks ago, large transaction over 700 doors, multi-million dollar business. Their offices were like a 7-minute car ride from each other. They did not know each other existed. They've probably driven past each other. They probably go to the same Starbucks. There are great operators around you that are potential buyers. And so if you're not involved in your network already and kind of prepping like, hey, who are the buyers that I need to be talking with, maybe building relationships with before they even, formally, offer their business to someone. This is all part of this, idea that you can prepare to exit. You don't need, potentially don't need a business broker to help funnel those buyer leads to you, right? Those buyer candidates are out there. They're probably already in your network. And if not, they're ones that you can start having, a relationship with now and essentially filtering through, right? There might be 3 or 4 different groups that could be buyers and you could get to know each one of them and figure out who is the best buyer candidate that you want to work with.
Now let's throw another plug in there real quick for working with PMI. Not only will we waive any kind of broker fee and we're a free resource for our franchisees. If you work through us, we can identify, hey, we have like 3 really good operators in this area who already know property management. You're not going to have to hold their hand and train them on how to run a property management company. We've already identified these ones would be great fits, but I'm going to let you guys meet each one of them and determine who do you feel best about selling your business to. So it's kind of a great situation. And we've got franchise partners all across the country. So, it's rare that we come across a business that we're like, oh, I don't have a buyer for you. Sorry. Like that doesn't really happen. So, yeah, little humble plug there, like give us a call because we'll help you through that process.
Yeah, it's just kind of interesting timing too. Like, more recently there was opportunity, I'll just say on the Pacific coast, without giving it away. But yeah, we had 3 buyers for the one seller, and the seller at their option, they decided to interview all 3 of them. And there were 2 that kind of stood out initially, and then they went through a financing element, and one was a clear standout, and so they selected that buyer. But there definitely was kind of a courting period between it, right? It's not to say, hey, this person is qualified to purchase it. It's, hey, is it a good fit, right? Is this buyer, a cultural fit for the team that I have in place? Like we can definitely shortcut that. We've got obviously a network of buyers and we can align with the right buyer for the business. And it's sometimes more than just, is it the right market? It's, hey, is it a good fit for the buyer and seller? Is it a win-win? Um, but yeah, like I said, it doesn't have to be a rushed process. Finding the right buyer is critical. Start on that now, right? Even if you're going to exit in 2 years, you really should start whittling that down. If you're trying to, get the most value for your business, that means selling it to the right buyer who sees the vision for it, understands the upside for them long term. And like I said, it's a courting process that doesn't need to happen overnight. You can build relationships with the right buyer candidates and get a fair dollar at the end of the day.
Our model is we like to, you know, part of our discovery is we'll have a conversation with the seller and be like, hey, what are your motivations? What are the things that you care about? What's next? And it's not like we're doing this to try to like get some negotiation edge or something like that. It's we want to know what's your next thing? How can we factor that into the how we structure our offer? Because like we want to build the offer around both sides of the table of like, hey, what's really going to make this awesome for you as well as for us. And so our model is we give an A B option. Option A, hey, we're going to come in. Here's the full cash at close option. And option B is, well, rather than paying the bank, we'd love to pay you. If you want to be the bank, here's a different option, and here's how we can structure it around your goals and your objectives of what you want to do next, and how we can factor that in to make sure that this is really sweet. If you will finance this for us, we can sweeten the deal even more so, rather than going through the SBA process and cost of capital. It's like if you work with us, if you help finance this, we can find creative ways to make it even sweeter for you.
Yeah, I would just say, I mean, for the seller to be upfront about what commitments they need, right? They may have a new project they're getting into. They might have some commitments to the family, right? Like I've this is an early reference, but there was someone that was exiting their business and they had promised their spouse they were going to pay off a property and also buy a boat. So kind of a funny thing, but they had some minimums that they needed cash at close for, and they were open about that, and we were able to get them to that target. I would also just say sometimes they have an exit goal that is maybe larger than the true business value. And so, it's interesting, but we can get pretty creative on how to hit those targets, right? Maybe there's other metrics we can include. Maybe there's some targets we can set for the business, other growth, kind of rewards or bonuses. Sometimes let's say you're halfway through a year and they project the year end out to be a certain dollar. And so if we hit that dollar in year one, another amount could be due. So I mean, we like to work backwards from the goal, right? If they've got a goal of X, the seller has a goal of X, we try to figure out a way to hit it. And if we can't, we'll be super upfront on why and any other constraints around bank financing. The one comment I'll leave into that is, in the scenario that the bank doesn't get excited about lending on the deal based on the seller's needs, right? Let's say it's $1 million business and the bank says, hey, we won't fund anything over 700 on it. That's their opportunity to sell or finance the deal. Our buyer is either going to pay the bank interest or the seller, and we'll be super upfront and transparent, about that process. So like I said, for us, we want them to get a win, right? The seller deserves a solid win. They worked hard for their business. They should get paid for it. But the cash to close scenario is typically based on what the bank's going to finance. And if they're not willing to finance it at that seller's needs, then hey, let that be the seller's opportunity to make more than what the bank would earn on it, right? So,
Do you remember that one deal that we worked on where I think it was out here in Arizona where the seller, we were like, hey, you're selling your business. You're still pretty young. Like, what's next? And they're like, oh, I've got this idea for this e-commerce business that I want to do. And I was like, great. Talk to us about what your cost of living looks like and what kind of seed capital you need. And we tried structuring a seller note on this around like, here's some money down. Plus, we're going to cover your living expenses while you get your e-commerce business ramping for the next, how many years. And so we were really building our offer around like, sweet, we would love to support you in your next venture. And here's how we think this will help lift some of that burden off your plate. At the end of the day, they're like, I'll just take the cash offer. But at least it's like, we're very collaborative in that process. But a caveat here, if you're trying to sell your business, I think the best scenario for doing seller financing is if you're selling to somebody who's already operating a property management. It takes a lot of trust to do an acquisition. Like both parties really have to trust each other. But if you're going to sell it, finance that means the seller is sharing in the risk of this transaction here, right? And that's also part of why the buyer is like, yeah, I'll pay more if you're sharing in the risk because now we're both incentivized to make sure that this is a success. But if the buyer already knows how to operate a property management business, it's a little bit less risky for the seller because they already know what they're doing. They've been doing this for years. They're already successful at it. chances of them tanking this business are a lot lower than somebody who's never run a property management business, right? So if you're going to seller finance, it should probably be seller financing somebody who already knows how to operate this business.
Totally, I couldn't agree more. Yeah, I mean, seller financing it for someone that's in the space, that's proven in the model, like that makes a lot of sense to me. And I would say, even if we reference the data behind our seller financed deals, I'd say the majority of those are going towards an experienced buyer and experienced operator in the PM industry. And, seller financing on a deal that's smaller. Let's say the buyer's business is larger than the seller's business, right? They've got a proven, operation in that market. So yeah, that's a big trust builder piece. And I would say finding the right buyer kind of leads into that too, right? It's someone that you'd be confident enough in to potentially seller finance, even if that's not the ending terms of your deal. Um, yeah, it's an opportunity, and there's definitely some risk on both sides of that. And it's good just to know what your options are. So looking at kind of like an A and B structure, like Hunter mentioned, like see what the difference is, see what all cash at close is, consider kind of the tax implications of that too. We've worked with some sellers, even one right now that says, "Hey, I cannot close on this in 25. I've got to wait till at least January to close on this just for tax purposes." And so, it's that diligence process is critical. Understand the tax implications of a sale, and you may want to structure a seller financed option, to your own advantage, not just for a higher multiple, but for other tax purposes too. All depends on really the seller's involvement in the business, and I would say the size of the business too, right? The obligations that they have to help transition this business to the buyer. I would say typically that could be anywhere from 2 to 6 months. The sweet spot in there is probably around 3 month window to help with transition. If the seller is fairly removed from their business already, that transition period might be smaller. But for an owner operator that is, deep in the operation of their business, they really need to think about that 3 month window. That doesn't mean 3 months of full time, clocking in every day. It's really more of, hey, the first month full time in person, and maybe the following 2 months could be available by email or phone call. I'd say that's pretty common with the deals that we've done.
I'd say it also comes back to those three different buyer profiles, right? Like if you're selling to an entrepreneur who has not operated this kind of business before, well, they're going to need a lot of hand holding. They're probably going to need 6 months, maybe more, right? If you're selling to one of your competitors down the street, somebody who already knows how to operate a property management, a lot less hand holding. It's more so all they need you to do is hand off relationships. So it's like we typically do like 3 months at the most, but it's really tapered. It's like, hey, for the first few weeks, yeah, you're going to sit down with us full time, but that's because you're going to show us how you've been operating compared to how I've been operating. And then it's really just handing off the relationship. So it's really tapered, you know. But if you're selling to a private equity group, remember they typically, if you can get their attention and they want to buy your business, they can typically offer a much higher price tag. But a lot of times that comes with strings attached in the form of, but you're going to keep working here as an employee of the business that you created for the next 2, 3, 5 years, right? So it all depends on who that buyer profile is, and so that time frame of what you should expect for a transition depends on who you're selling to.
Yeah, that's a great point. I think we saw some feedback from a seller the other day, and they had received some offer from someone else that was slightly higher than the valuation that we had put on it. And I think behind all of that, a buyer that's willing to pay that for that business probably is going to keep that seller in it for at least a year, like Hunter mentioned. And a lot of those payouts, when they get into those higher multiples, there's definitely more of a post close revenue kind of contingency or performance metric that's tied to that compensation. So it might be $1 million payout when it's all said and done. If this revenue target is on trend, if the percentage points up every month, if that target's been hit annually, there's other language there. So it really does depend. But If a seller is willing to stay in their business for a year or two with another owner in place, the feedback I've usually received is, why wouldn't I just stay and own it for another 2 years and grow it? So, so yeah, there's a lot to consider there for sure. But like I said, a 3 month is probably the maximum that I would typically suggest. Anything beyond that, is pretty rare just within the transactions that our team sees. I think there's got to be a plan in place for team and clients well before closing. And so when we go through our extensively long due diligence checklist that Hunter has been the mastermind behind, there is a piece in there that's going to relate to this. And so when it comes to clients and employees, typically our buyers, when we're looking at it, we need the team, right? Like, we want good team members that are in place. We want quality clients that are great to work with. Our goal isn't to ever, for our buyers, we don't want them to stir up any dust. We just want to make sure that they're continuing a very high level of service that they've been receiving from the seller. And, we kind of have an internal, question around this. It's like, hey, if we're going to get into this deal, we need to be confident that we can provide equal or better service. And, so client and employee retention is everything for us. Sometimes the seller might give us an indication that, hey, there's a team member that's not a good fit for the business now. They might choose to make a change before they even close. But ultimately, we love the team that's in place. We want them to just keep doing their job. We want to make sure the clients are taken care of, and that no one's really noticing a huge shift. We're going to continue that high level of service. And I'd say it's a rare transaction for us that we don't have the team coming over. We typically always want the team. So we lean pretty heavily into that, even in valuation, when we walk through the seller's org chart and, identifying, maybe there's some areas we need to add team members to versus actually remove or replace. Right. So, I mean, we deal with really both sides of that within our network, so, I think my own bias would suggest, like, hey, how much time do you have? Right. Like, in my opinion, I wouldn't want to spend 3, 5+ years building something purely organically. I think there's a healthy blend of acquisition that stimulates organic growth. So when a lot of people talk to me, they always assume that I'm only talking about acquisition growth, but I realize that my organic growth is actually really heavily based on my acquisition growth. Can I get into a business within the next 12 months and help stimulate organic growth, through acquisition? I think so. And that's what I've seen proved out, over the years that I've been doing this. But I think you can do both. It really depends on the operator. We've got some people that just come in and they want to have a very, I'd say, you know, like, curated portfolio of management contracts. They're very specific on what they take. That they're not concerned about, scaling as quickly as some of us are with acquisition. But I absolutely lead towards acquisition growth, not just because I see it every day, but also just because I've understood the industry. And this may be true of other small businesses, but I think if you want to get into the space, you should absolutely start with an acquisition. That's just, my opinion.
This one's fun because my bachelor's degree was in entrepreneurship. And you want to know something that I learned? 90 something percent, 95% of businesses, startups fail. Like, most of them are gone within 3 years. And then the rest kind of trickle out after 5 years. But there is a theory that I can't remember the name of this theory. And it goes that if a business has been around for 10 years, if a business hits that 10-year mark, chances are it will keep going for another 10 years. Right. So I'm definitely a big fan of, like, the idea of starting a business from scratch seems risky to me. The failure rate is just so high. Chances, like, the odds are stacked against you. But if you buy a business that's already been around for 10 years, chances are it will continue onward. Why not start with that business and grow from there? Right. So to me, starting a business seems much, much riskier than buying a business, even though it It doesn't feel that way when you're the one taking out $1 million loan to buy that business because you're like, man, that's a lot of debt. But you're buying a business that's already proven itself and already has revenues and cash flows coming in. It's already got teams. Someone already did the heavy lift to get it to that point. And my mindset is start there, because like there are some people who are built to start a business out of the clouds, and they can get it to this point. That's as far as they can take it. And they're a special breed. Like not a lot of people, everybody wants to be an entrepreneur. Not a lot of people have the ability to do that. Start with zero and get it to here. But a lot of people, like that's as far as they can get it. And then there's a lot of people that are like, well, I could buy it from here and take it to here. Right. And so my view is starting a business is a lot riskier, and you really have to be a special breed to be able to start a business and get it to that point of sustainability. So why not buy a business that already made it to that point, already has infrastructure and systems? Someone already did the heavy lifting to get it there. Start there, grow from that. And then also, conversely, people are like, well, I've built my business and I got it to here. Should I buy a business or should I put that money into a marketing campaign? And my mindset again is, well, your marketing campaign is still just a theory that if you dump all this money into marketing, that it will work. Or you could put that money into buying another business that is already proven to be working. Right. So I'm definitely biased, but I'm definitely a fan of buy a business and build from there.
Totally. And I know, Hunter, you and I are absolutely aligned on, we both read, Walker Daybell's Buy Then Build. If anyone hasn't, they should add that to your book list. But yeah, I mean, starting with some framework, it's not to say that the business you buy is absolutely perfect, but it absolutely gives you the framework to improve on and build on, and opportunity and immediate market share, right? There's some markets that I wouldn't consider organic growth in. First, I know some organic growth can be easier in some markets, but acquisition growth, you could take advantage of that in any market. So I think that's where your opportunity is. And that may be me leaning more towards my experience in the property management industry, but I think it's true of most industries too. Buying first and then building. In my experience, has a higher success rate. Are we giving away secret sauce here? I mean, there's no secret sauce. That's the truth. Finding the right businesses. It's not about public listings, like we said. You know, Public listings are for those, and we've probably said it before on other episodes here. I mean, they're for people that don't know what type of business they want to buy. You already know what type of business you're looking to buy, right? You're looking for a property management company, like talking with sellers directly, not going through the public listings. That's kind of typically channeling you through a business broker. Just go talk to the owner, talk to the business owner. This is true of any industry. you know, go talk to the people that own these businesses. That's how you find them. There's no secret sauce. There's no, magic, I'd say app that does this for you. It's text messages, it's phone calls, it's meeting in person, it's having lunches, having coffee, it's networking. Uh, don't complicate it. We see people try to complicate it all the time, and we just tell them just go meet in person. That's how relationships form. That's how you find sellers, and
Don't overthink it.
what's been working with for us for years now. It's all in person. It's all local.
Yeah. Think about the customer. How do customers find them? Okay. Go through that customer journey. Be a customer. Go find, how do you find another property management company? Okay. Well, now go contact them, go talk to them. Right. We always say, like, people are like, what property management business should I buy? How do I find them? And we're like, well, how many other property management cell phone numbers do you have? All right, you don't have any. Well, how are you going to get some? Like, go knock on doors, go walk in, introduce yourself, like go to networking events, because business acquisitions takes a ton of trust on both sides of the table. The best deals are going to come from those that you already have relationships with. So start building a relationship with your competitors. go go talk to the other property management companies, get the owner's cell phone number, buy them lunch, talk to them, talk shop, and eventually that's more than likely where your deal is going to come from.
Yeah, it can take time, but I think just you know have some fair expectations as a buyer, right? A potential seller, maybe isn't going to share financials with you at the first meeting. Maybe they don't have a price tag. Maybe they've never gone through this process before. You got to kind of build that relationship first. Ultimately, sellers are always going to give a lot of information. They might answer some questions that you didn't even know you had, right? Just like Hunter mentioned, talk about their business. If you're already in the industry, right? It's really easy to just compare notes like, hey, what are you going through? Hey, are you seeing vacancies at a certain rate right now? Any local, you know, legislature that's going on in the space? Like, you're already in the space, talk to them about what you're going through and what your business looks like. They're going to share a lot about their business, but don't expect to get price tags and financials and rent rolls and contracts on the first date. It's just not going to happen. Financials are really just something that could be looked at easily and upfront. And if they're not clean, if they're not organized, that's an immediate red flag. It's probably an indication of other things in the business. Just I'm also trying to think about the contracts, right? If we've got older contracts, if there's non-assignment issues, if they have limitations as to, you know, flat rated fees, like a flat rate fee business versus a percentage fee business. The org chart, I mean, I start with Google reviews. I mean, I'm looking at their presence. I'm trying to understand, how they operate in the space. So it's not to say that there can't be some bad reviews on there from a tenant issue that maybe that tenant wasn't being realistic too. But if they've got bad Google reviews, like that's one thing I actually encourage, sellers to work on when they're trying to increase their value too. Like you're not soliciting your clients and tenants for good reviews. So if they've got bad reviews, that means they're not proactively going after good ones either. So yeah, Hunter, you probably have some other ideas too. I know I hit a couple of them.
Yeah, the first red flag is contract assignability because that makes the deal tougher, right? That adds complexity if the contracts are not assignable. When looking at financials, property management businesses are typically pretty stable, right? There should not be a lot of volatility in these. And so it's if there is volatility, like the revenues are everywhere or the revenues are declining, why? Like, what the heck is happening? It's okay if the cash flow is declining because that could be explained away with like, well, we hired headcount because we're growing. Look at our revenue growth. But if revenue and cash flow are declining, what the heck are you losing contracts? Also, high margins, right? When we start looking at if the business is over 35% profit margin, that's telling me I think the owner is doing a lot in this business, right? They're handling a lot of the roles. So that's another red flag if the owner is doing a lot, that key man syndrome that you've probably heard people talk about. So I think those are the first red flags that we're looking at. But another one is client spread, right? If you've got a portfolio of 500 doors that you're managing, well, what if one owner owns 100 of those? Right? That's a big risk element of like, well, is that owner only here because they're golf buddies with the business owner? Like what happens what happens if I buy this business? Is that how likely is that person going to stay? Because if they leave, that's 20% of the portfolio. That's a huge hit. So that's another red flag. You want diverse client spread, like an average of, 2 or 3 properties per owner. You don't want 10% of the clients to own 40% of the revenue.
No, that's a great one. I was thinking about we were dealing with the valuation on a company that like it was primarily servicing one client. I don't know if you remember that one, Hunter. But yeah, that's a big piece, right? There's got to be a fair spread in there. One other red flag, though, too, and obviously when we are in our diligence, looking at trust accounts and reconciled trust accounts and how they're handling maintenance, like there's some industry norms, right, that should be upheld. And we can pretty easily tell when someone's in touch with the industry and not, someone that's been managing for 20 years and never updated management agreements. So Yeah, agreements, absolutely. That assignability that Hunter mentioned, I would definitely lean into that. That's another great thing that sellers can work on improving on and modifying, whether that's through addendum or new agreements. If they do have non-assignable agreements, and if they are thinking about selling in the next 6 to 12 months, then they should be working right now to make sure those agreements are assignable. It's going to be more valuable for them. It's going to be a smoother transition process. And but yeah, that's a short list of red flags. There's a lot of ways to put these deals together, right? There's really 100 different ways to structure it. I think bank financing now more than ever, there's been great lenders out there that we work with that are excited to lend on property management businesses. I'll name drop Live Oak Bank in here right now. They've got a great team with Jordan and Graham and the others on their team that have a property management specific team in-house vertical within Live Oak Bank that only handles property management business transactions. So there are banks that are excited about these deals that like I said, that in combination with other purchase options, including seller financing, including profit share, revenue shares, earnouts. There's, like I said, a lot of ways to do it.
I think you have some good points in there. Live Oak, they're great to work with. They've got a team specially dedicated to working on property management acquisitions and lending for those. There's so many different ways to finance a deal. One thing that I'm going to point out, like there's so many online gurus out there like preaching that you can buy a business with zero down. And I'm like, if you can do that, like you're an absolute rock star. But in my mind, the seller deserves something at closing. You know what I mean? So don't go in expecting that you can buy a business with $0. You could buy a business with zero of your own dollars, right? That doesn't mean like you could go find an investor and be like, hey, I'm buying this business and I need X amount for a down payment on this, and I'll give you some equity for it, right? That's one way. There's so many ways you can get creative with it. But I would say your BATNA, that's a negotiation term, your best alternative to a negotiated outcome or negotiated agreement is I fall back on an SBA loan, right? We can get creative with how we want to do any kind of seller financing here. Whether, hey, I've got some money and I've got this family and friends that have some money, and then we're going to go get, a bank loan, a conventional loan for like 200 grand or something. And we're going to put this all together. And then the seller's going to finance the rest. Like there's so many different ways you can do this. But your best alternative to a negotiated agreement, your fallback is an SBA loan. Okay. You can get an SBA loan and they're going to pay for 90%, they're going to finance 90% of this acquisition, meaning you have to find 10% down to put on this. And so, whatever kind of business you're looking at, if you're like, hey, I only have 10 grand to put down on a business acquisition, you probably want to go find some more capital, whether that's from you or Uncle Jerry, whatever. Like I like to tell people like, can you put together, if you needed to, could you put together $100,000, whether from your own money, a HELOC, or friends and family, or you have some investors that you're aware of? Like, could you get 100 grand that you could put on a down payment for an SBA loan, right? Because that's your best alternative to a negotiated agreement. Is getting an SBA loan. They'll finance 90% of that deal. Or could we figure out some sort of creative financing where the seller is financing this deal for you, right?
Yeah, the only thing I'd probably add to that is, we've worked with some buyers on a number of transactions, I mean, one up to 10 deals, another one that's done three, fingers crossed, a fourth one in Colorado. And I would say, getting into the space, if it's your first deal and a seller maybe isn't as apt to finance, maybe you need to go SBA for deal number one. It's not to say you need to go SBA for or go with an SBA back loan for every deal, but if you're a new buyer in the space, that's really a great card to play when a seller, is maybe trying to get some more confidence in you as a buyer, and wants to get a larger check at close. So SBA is a good option for the right deal. It's also just a good idea to qualify each opportunity against a bank loan to understand, how they view the business versus, hey, maybe your risk tolerance is different than the banks, and maybe the sellers is as well, and they're willing to finance it. But But yeah, I think every deal you should look at bank financing, and maybe it's even more than, one or two banks. Maybe it's two or three banks, and shop that around a little bit, understand what your options are, and realize you may not need to use it on this deal, but you might do a second or third transaction where those banking relationships are going to come, into play.
To be clear, the SBA has a cap of $5 million. So they can finance anything up to $5 million. And so that's why it's like if you're buying a small business up to 5 million, that's your best alternative to a negotiated deal, right? That there's your bat for financing. And if you're a first time business buyer and you're trying to buy something above 5 million for your first deal, that maybe start with an SBA range deal first. So you understand what's going on before you're like, hey, I'm going to go buy a $10 million business, even though I've never done this before. Right. So that's why it's like the SBA is a great product, especially for existing operators, existing business owners to go and buy other business and expand their business through acquisition. Awesome, awesome tool that you have at your disposal.
Yep, love it. Especially like the expansion loan element of that is key. So yeah, you should definitely be talking with a number of banks and just educate yourself through the process, right? One bank might be a better fit for one deal than another one. So yeah, like I said, 100, maybe a million ways to put those deals together for sure. The general rule, maybe not rule, but from what we encourage is your first deal should be in your backyard. Get familiar with the process, financing, transition. Don't buy a business that's a 5-hour flight away for your first deal. You can do that one later, but your first deal needs to be, I would say ideally within a 45-minute drive at the most. If it's in your backyard, if it's down the street, even better.
Yeah, 45-minute drive. We tell people all the time, if you can't drive there in 45 minutes for your first one, it's too far. The reason being, like, let's be real and honest. Business acquisitions, it's a great investment asset class, but it's not risk free. Like, there are definitely a lot of risks. And I'll say every business acquisition will come with fires. Something will come up. You will have to put on your volunteer firefighter helmet and just get to it, right? And so if that business, if you live in Colorado and you're buying a business in Florida, like, man, if something happens, an issue comes up, a fire arises in that business, what are you going to do about it, right? You're causing more risk for yourself and more problems for yourself. You're making it harder if you're buying outside of your market. There are so many businesses for sale all over the place. In fact, 100% of businesses are for sale for the right price and the right terms, right? But there are so many companies in your market. Start there. Like, there were so many businesses. So just start with your market first. Get your feet wet with your first acquisition. And then if you decide, hey, this was awesome and I'm totally for buying in another market, go for it. Be my guest. But for your first deal, I definitely recommend buy where you're at, right? If you want to go buy a business in another state, you better be prepared to move to that other state and go live there. Like, be where you buy.
Totally. I think we have that conversation with buyers pretty regularly, and we always have to put a lot of pressure on that. Like, we've seen both sides of that, but ultimately get familiar with the process when it's down the street. Let's prove the model, right? Prove that you can buy, own, operate a business down the street, and then be more open to some of those opportunities that are they may even be in the neighboring market, or they might be states away. Either way, do the first deal down the street. I mean, we deal with businesses of both independent um, PM companies and also franchise models, of course, with PMI. But there's a lot of pieces to the franchise that a lot of people outside of it don't understand. For example, the resources that they get purely just from our team, which is a small portion of the 100+ team we have on the corporate side. We have this acquisition resource that's available to franchise partners, people within the franchise network. We don't third party out our services. We're not business brokers, so we don't charge any of those fees. And so I'm still amazed at what the corporate side does provide on the acquisition front, and everything that's available to them. I would also just say we talked about Live Oak Bank and other lenders. The lenders that we work with, they like working with our PMI franchise partners because there is a team behind them and their local team. There is this national team, this PMI corporate team that provides an amazing amount of resources and not just help with diligence, but negotiations and transition and software and all these other moving pieces. It absolutely takes a team to do these deals. So I think there's a lot of benefits to the franchise model. I don't know of other franchises that do what we do in our space. I know there's other brands out in the PM side in the franchise world, but I don't know of any other groups that do acquisitions on the scale that we do. Not meant to be boasty, just a reflection, I guess. But
Yeah, I think one of the reasons we talked about buyer profiles earlier, and you have this crowd of enthusiastic people who want to get into entrepreneurship and be in, buy a business even though they've never done it before. And I think that's the highest risk profile with buyers is people who have never operated this business before. The benefit of working with PMI, again, like humble plug, go with PMI, is when our franchisees buy businesses, they either have years of experience themselves or they have an entire franchise network behind them with years of experience. So that's why it's like there are other people out there who are buying businesses on their own, not part of a franchise. They fail all the time, right? We have yet to have a franchise buy a business that defaults because they're not alone, right? It's not Jimmy by himself buying this business. It's Jimmy. It's like those old Verizon commercials where the guy's like, "Can you hear me now?" And then behind him, there's like a whole army of people, like good, That's kind of what it's like. That's why people would buy into PMI's franchise of, hey, I'm gonna be backed by this resource. So it's kind of a benefit. It's like, what do you want? Do you want extra support through a franchise, or do you want to go it alone? One of them is riskier than the other. One path, right? I think that's why people choose to go through PMI is because the benefits of not just the acquisition team, but it's like we have whole departments that are dedicated to making sure that they are successful with operating the business. So
yeah, there's a lot to unpack there for sure. I think just on the diligent side of things, like people really need to understand the industry, understand what resources they have with whatever business it is. So even if that's the existing team that's there, I would say the success of our transactions, it's not just because we have a great local buyer, but even on the corporate resource side, like our acquisitions are successful because we have all of these other team members to help solidify that and ensure that it's going to be a smooth transition, ensure that we're following the best practices. And so yeah, I say on the diligence side, learn a lot about all of the resources and whether it's a franchise business that you're buying or not. Understand the team, understand the resources, understand the expenses to that as well. And that's something I get questions on a lot regarding franchises, and any type of royalty type elements. Those are expenses that are there within the business. And if the business is operating smoothly and profitably, and there's, some obligation to a franchise brand, this is in property management and within the real estate world, right? There's plenty of franchises in the real estate space. You think of all the Keller Williams, the Coldwells, the Weicherts. There's a list of them. And I'd say it's probably only adding to the value of these businesses now when they are in a network like ours, because we have plenty of buyers that are looking specifically for PMI franchise resales. So so there's a lot of value in the brand, in the network. And yeah, biased opinion, but I think there's great businesses out there that are within franchises and outside of franchises. I think that's absolutely true. Single biggest mistake to avoid. I would say going into the deal by yourself, like you don't want to just do it alone. We've seen people try to do that. We've seen people fail at that and then come to us wanting to sell their business to a PMI office. Just don't do it alone. Have people in your corner. use the right team, attorneys, CPAs. If you've got, franchise, acquisition resources like us, of course you can do that. But just don't do it solo. You need a second set of eyes on everything. And that might be a spouse, but it should also be someone else. So get a couple sets of eyes on every deal. That's my advice.
You might know how to run a property management business, but if you've never bought a business, this is a big investment. You know, you might be taking out a loan, personally guaranteeing a few $1,000,000. And if you fail, you lose your house. Like, don't, if you aren't the expert at it, don't try to do it by yourself. Get the right team of experts to help you through this process. That's the best advice that I can give. Like, that's the biggest mistake that people make. The people who are filing bankruptcy because they bought a business and failed are the ones who tried to do it themselves. There are people who can be successful at it. They can buy a business, they can figure it out, stumble their way through, and they'll be okay. But is that a risk you want to take? Right? Would you rather just hire the right who's that can help you make sure that you mitigate as much risk as you can? So if you're not the expert, get a team, get people that know what they're doing that can help you through the process. That's the best piece of advice.
Yeah, I just want to thank everyone for joining this episode. I think that there's a lot of value we can provide to this network. I hope that listeners and viewers are engaging with it and can appreciate that there's a lot of hard work, but it's really fun for us. And so, we talk about this all day long in our Slack channels and our Zoom meetings. And I'm just excited that we can share more of that with the outside network. But yeah, that's it. I just want to sign off from there and look forward to seeing everyone on the next Managed to Exit podcast. So appreciate it. Thanks, everyone.